Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 a.m. on KATX and KWBY as Angela Robinson joins Stace Gaddy to share important financial information to help you live life on purpose, insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
Good morning, my friends. Another edition of Life Planning 101, as we do every Monday morning at this time. And then a rebroadcast on Saturdays on both KATX and KWBY. It's always a pleasure. Angela Robinson, our guest and expert from Kennedy Financial Services. Happy Monday to you, ma'am.
Happy Monday, and what a great Monday we've got lined out. It is tax season, as everybody knows.
Yes.
And even though we've got an April 18th filing date, that is the good news about this year. The bad news is we still have to file our taxes, right?
Right.
So we are going to be talking about taxes quite a bit today. I've got some great little tidbits to go through. I've got a lot of different strategies, and then what I do want to touch on is we are already looking at some 2015 situations, and every year when we look at these, we find something that we had never seen before. And now a couple of these are things that we've seen before, but maybe not to this extreme. I'm going to be talking about 3 things that we've seen this year already that have been 5-figure marks on people's tax returns. So in other words, costing them
Yikes.
5 figures in taxes, and they really, in a sense, may have been completely unnecessary. Think about that.
Are these new regulations or just we don't know about them?
It's simply just not doing your homework, right?
Okay.
So I think in a lot of ways, and it's not just to blame it on one person necessarily, because a lot of times with taxes, and you got to remember, Albert Einstein said he couldn't even understand the U.S. tax code, okay?
Right.
So once you realize that, I don't think there is one tax planner out there that probably knows everything about the tax code. Like I said, we are learning all the time, all right? We've been doing tax plannings for decades. So this isn't something that is new to us either, but you just mentioned something. They are changing things, and maybe it takes 2 to 3 years to see them actually come into effect. And then when that actually happens, and people don't pay attention to it, or you don't necessarily go sit down with your CPA or your accountant and plan for these types of things. And then sometimes it has nothing to do with your CPA or an accountant. One of the deals I'm going to talk to you about was completely on the investment advisor, had nothing to do with the accountant at all. So there's a lot of good stuff here, and at the end of the show, we have a guest speaker, our own CFA, Chartered Financial Analyst, Aaron Kennedy, going to be talking to us about the markets. I know everybody is probably anxious to hear about that. We've had quite the whirlwind over the last 12 months. Things are still negative, so I know there's going to be a lot of pleasure about having him on the show. So let's get to it. First tidbit for today. And by the way, this is something that I brought back because we haven't been doing it, and I think it's just too good. Potentially save your bacon tip of the day.
That's right.
All right. So here it is. I found a form. It's called the Stolen Identity Form. It's a tax form that you can actually fill out if you think you've been a victim of identity theft or have concerns about your situation because of certain happenings, or you've had your identity stolen in the past. You can actually fill out this form to protect yourself for the IRS, for someone else actually going in and filing on your taxes. Pretty cool, huh?
Yes.
So this is form 14039. 14039, stolen identity form. You don't want to be able to miss that. Now, let's get down to the meat of the conversation. First thing I want to talk about is a little thing called the PEAS limitation phase out. Now, I know that just sounds...
What?
Yeah, right?
Say what?
Leave it to Congress and the Senate and the IRS, so they come up with the names. But let's say
But you're here to explain it.
That's right. That's right. Last year, and this is something that we saw, but last year, let's just imagine that you could take $150,000 of itemized deductions on your tax return. Okay, now those itemized deductions, those are things like your mortgage interest, your health expenses, maybe your other taxes that you pay, miscellaneous expenses such as job expenses or investment expenses, those types of things. And charitable deductions are a big part of that as well. So let's say that you take $150,000 of those deductions and you go to file your taxes and you get them back and you realize that you could actually only take $30,000 of them. That's an 80% reduction. What does that cost you? That's up to $52,000 in tax issues. Is that not a problem?
That's a problem.
That's a problem, right? So how does that happen? Well, if you make a certain amount of money on your what you call your adjusted gross income. That's at the bottom of the first page of your 1040. If you hit a certain amount of money at that, then everything above that, you get a 3% reduction on those itemized deductions. That's how the P's limitation works. So, what can you do to offset? That's the big key, right? How can you actually avoid it? And you can. There's several ways. First of all, retirement contributions. You've heard me talk about that on the show before. You can actually take up to $210,000, shelter up to $210,000 in retirement contributions for 2016. That's big.
Yes.
That's really big. Sending your required minimum distributions straight to a nonprofit. So this is something that Congress actually put permanent into the tax code last year, is that you could send your distribution amounts from your IRA straight to a nonprofit, and it doesn't even show up on your tax return. How awesome is that? Okay.
Fantastic.
Yes, it is. So instead of taking them outright and then actually gifting and trying to itemize that deduction where you might end up losing it anyway, why not get that guarantee? That's pretty awesome. Health savings accounts. Okay, this is one of my favorite little tools. A lot of people don't realize this, but a health savings account might be the only place that you never have to pay taxes. When we come back, I'll explain that.
Yes. What a tease. Talk about a cliffhanger. Yeah. Oh, fantastic. Folks, if you just joined us, you're listening to Life Planning 101 on KATX 97.7 and KWBY 98.5. Angela Robinson from Kennedy Financial Services right here in Eastland, our guest and expert. It is tax season, 7 days and counting. All the information you need to know right here. We're back after a short break. Welcome in, folks, to the second segment this morning of Life Planning 101. I'm Stace Gaddy, our guest and expert, Angela Robinson. Tax season.
Tax season, yes. And want to be able to remind everybody, we do reward the best question of each week. This week, we're actually giving away a free tax return assessment. And just so you know, anytime we do any type of assessment, consulting, anything, we charge a $500 minimum fee. So it's a pretty good offer. Make sure you email us, lifeplanning@kennedy-financial.com, lifeplanning@kennedy- or dash, however you want to say it, financial.com. Email us your best question of the week. We will be doing some trivia at the end of the show, so make sure you listen up to everything, all the facts and figures. That should give you a hint. So let's talk about the penalties of not having health insurance. Last year, if you didn't have health insurance, it would cost you up to $975. This year, that's going to be a whopping $2,085.
Wow.
So make sure you get your health insurance in place because that is a big deal. And now back to the meat.
Time out. Is that for any individual or a particularly aged person, or that's the standard?
That's the standard.
Wow.
So you will be penalized if you don't have health insurance. Remember the Affordable Care Act and what all went with that, and that's part of it.
It's kicking in big time.
It's kicking in big time. So make sure you've got that in place. $2,085 will be your penalty this year. Health insurance may be cheaper.
Yeah.
Think about that. So let's talk about those above the line deductions and getting those, getting that P's phase out down, or making sure that you get those above the line deductions taken care of, so you aren't having to pay taxes that are unnecessary. Okay, so we did talk about health savings accounts, and I said this may be the one place that you never have to pay taxes, right? And here's how it works: you get a deduction for putting money in. It grows tax deferred, and as long as you use it for health reasons, qualified health expenses, which is basically anything health related, it comes out tax free. What a deal.
Nice.
Okay, so take advantage of it. If you are in a high deductible health insurance plan, you can contribute to one of these. $7,650 is the maximum contribution for a family this year. So make sure you take advantage of that. That's big. And then let's talk about investments for a second. This is another above the line deduction you can take. There's a few different types, one of which we end up doing a lot with our business owner clients or those that are high income earners, is taking advantage of the Section 263 in the tax code. Okay, and this allows deductions of up to 100% of intangible drilling expenditures in an oil and gas well. Okay. So that's typically 65 to 80% of the expenses of that well. So imagine if you make an investment and you get to write off 65 to 80% of that investment. Pretty good deal. Okay.
Very good deal.
So it might be something you want to think about, especially oil prices, if they end up stabilizing and drilling prices are low, might be a great opportunity for you to think about those types of investments this year if they fit your situation. Make sure you talk with your investment advisor about that, though, because those are illiquid. And once you put your money into the ground, you aren't getting it back out. And, you got to determine the risk, right? If you're investing in one oil well, that's pretty risky, all right? So make sure that you think about the risk and see if there's potential for being able to invest in, 100 or 120, much like you would in a mutual fund rather than one. That might help mitigate that a little bit, making sure there's also other things that are taken care of in there. So big topic, but, lots around it, but it could help you tremendously. And then don't forget your business, your farm, or your ranch for those above the line deductions. A lot of people think I've got to go spend money to get a deduction. That's not true. You do proper tax planning, there are a lot of deductions you can take. When we work with people, we see it 5 figures of deductions you can take in your business without spending a dime. Think about that.
Wow. Yeah.
That's pretty big. So make sure that you're looking at all those options. All right. So there was our first big unnecessary expense. Let's talk about number 2, capital gains distributions from mutual funds. All right.
Okay.
If you think about the market since 2009 has basically done nothing but go where?
Down.
Not since 2009.
Oh.
Yeah.
Since 2009, yes.
Yeah, it went down in 2009.
It crashed
yes.
big time.
Okay. From March of 2009, from there
Since
on out,
then.
it went up. And really, there's not been much places for losses. So as an investor, you haven't been able to take losses to offset your gains in a lot of ways. Well, in a mutual fund, they have to manage that the same way. Well, because there's been no losses, they're having to distribute those capital gains to the investors of those mutual funds. And at the end of the year last year, we saw huge capital gains distributions, which were huge hiccups on people's tax returns. One of which we saw just last month, and it was a 5-figure hiccup. Now, the bad thing is investment advisors should know about this, and they should be talking to you about this and seeing if it's worth keeping that investment. Because like last year, you could have actually potentially harvested that loss. In other words, sold it, taken the loss because the market would have been shaky, not had the capital gains distributions, and instead of causing extra taxes on your tax return, it could have actually saved you taxes on your tax return. So that's a pretty big one. Make sure you're looking at that. Make sure you're investing tax efficiently. That's a big one. All right. And then the last one is the net investment income. Okay. This is the Obamacare tax, Affordable Care Act tax, however you want to say it. That's that 3.8% tax. And it comes at different thresholds, $200,000 if you're single, $250,000 of income if you're married. Okay. Now, here's where it gets tricky. A lot of people just say, well, I'll just owe it. Well, no, you just won't, okay? Because you can actually maneuver yourself here, because in the tax code, it's described that this will be applied on the lesser of your investment income or your amount of modified adjusted gross income. So in other words, your income over that threshold, whichever one it is, 200 or 250, okay? So let's take someone that's working and they just have W-2 income. They have no net investment income. They could end up having a 5-figure tax liability avoided if they just go take a savings account at the bank and have interest earned on their tax return. And now it becomes lunch money.
Wow.
Yeah. So just a little bit of planning there could avoid a
big knowledge.
Big hiccup.
You have to talk to somebody like you.
Yeah, you've got to talk it out. And you can't just wait till the end of the year to start planning, all right? If you've got taxes on your brain right now, in fact, there's a survey done all the time about people this time of year. This is when they want to talk about their finances, their planning, their retirement, their taxes. Why? Because they've got money on the brain, right? So take advantage of those internal motivations that you have and literally go out there and find someone to help you do your planning. It's too important not to do. For instance, try doing a Roth redo this year. What about, have you thought about, since the market's down, maybe if you did a Roth, if you converted a traditional IRA to a Roth IRA last year, what about recharacterizing that this year and then redoing it this year while the market's down and paying less tax on that? Might be a potential to do it. So
sounds good to me.
Yeah. So seriously, it's important to be able to talk to somebody about the potentials of what you can actually do on a regular basis, not just every once in a while. So everybody knows we've got a Twitter account, and I'm learning how to be able to say this. So tweet us, Twitter at KFS Life Planning, and answer our weekly poll. We want to know: do you think you are paying too little in taxes? just right in taxes
Okay.
or too much in taxes? Tweet us. We want to know what your opinion is. And be sure to like us on Facebook as well. I will say we've got some great newsletters that we put out with this stuff, as actually finishing up the one for this week. And if you email us, lifeplanning@kennedy-financial.com, or go on our website, kennedy-financial.com, you'll be able to see a place to sign up for those newsletters, and you can see it. And I know they're also archived on katxradio.com and kwbyradio.com.
Yes.
They're great corresponding articles to all this. So when we come back, we're going to be talking to our CFA, our Certified Financial Analyst. So I don't want to take away from him. Let's go ahead and do our trivia.
Okay.
Ooh, and I even said it during this segment of the show. So tell me, what is the penalty for no health insurance in 2016?
I know this one.
Was it $975? Was it $2,085? Or was it $3,075? Email us, lifeplanning@kennedy-financial.com. Because it is tax time, we're going to give away some comfort food, a free large pizza, toppings of your choice with this. So that way, if that penalty is too hard, make sure you tweet us, let us know, and then you can also eat some pizza, and that'll be good. And make sure you email us your questions as well. We are doing a free tax return assessment for the best question of the week. One of the questions we had last week was contributing to a traditional or Roth, which was best, right? And
Good question.
that is a great question, because should I be contributing and paying the taxes now, or should I be waiting to pay those taxes at a later date? And honestly, you know what? I can't tell you, because the bottom line is it's case-by-case situation. I would tell somebody now that's having a hard time saving anything, save the taxes so you can put some money back for yourself. But if you have excess cash, go ahead and pay the taxes now, because most likely, during your retirement, everything you have is going to be taxable. But again, is it going to be taxed at a lower rate? So there's a lot of ifs, ands, or buts there. But it's a great question. It is case by case, and I think that's important for people to know. Is you've got to work with someone. You don't try to do the job alone. You could end up hurt. When we come back, you don't want to miss it. We're going to get our market update.
Welcome in, ladies and gentlemen, to the final segment of Life Planning 101 this morning. I'm Stace Gaddy, if you've just joined us. Angela Robinson from Kennedy Financial Services, our guest and expert, and we have a special guest this morning.
We do, and boy, are we excited about our special guest. I tell you what, I know my brother goes back into the office every week when he can hardly fit his head in the door, because I have to give him a little edification on the show, and his head just grows. But, to be honest, my dad always tells the story that he was in school from the time that he was 5 years old till he was 30 or 40 years old. And there's good qualification behind that, because he has done a lot and he's consistently learning. And even though he's not out there trying to get another designation, I think the CFA kind of tops it all, when that's what the guys on Wall Street carry around that actually manage all the money up there. So for him to be able to have that education and that knowledge is extremely vital.
Yes, it is.
And I tell you what, we are so honored to be able to have that, because we walk back every week and we say, Aaron, what's going on? And he can give us an answer. And so that's invaluable, because we spend so much time in front of the clients that having someone full-time researching, analyzing, listening to other CFAs that are in the industry, talking with them and getting their opinion, I tell you what, it's invaluable. So Aaron, happy to have you on the show. Let us know what's going on with the markets.
Markets are doing extremely well. If you've been following over the last month and a half or so, you're probably actually really happy. The markets are pretty much right back to where they started at the beginning of the year after that big drastic loss. I think at the end of this week we ended up just a little bit lower, but that large drastic loss we covered that back up. So there's reason to feel a lot better about what's going on.
That's good. And I know we were looking over the last 12 months. We were just talking about this. We're still negative over the last 12 months. And I know we've been saying for a long time, people think we're crazy. We've said it on the radio show. A little pullback is good. It's healthy, right?
Yes, absolutely. Things are a little bit stretched as it is when it comes to price. And, you always want to be buying whatever it is on sale, whether it's a box of cereal or a great company like GE. And if you can go in and find a great price in an illogical time, it's a wonderful thing to do. Go in and buy stocks when they're cheap.
So what do you kind of see as the threat right now going on?
The main threat still seems, to me, it's going to be volatility. It's going to shake a lot of people out and get people really scared. Because if you would have look back at the beginning of February or middle of February, we were down, or the market was down between 10 and 15%, then that's hard for people to stomach. And, going forward, it's may not be that bad, but we are still going to go through volatility. GDP for this first quarter, which is the output for a country, is supposed to be not that great. Less than 1% and maybe closer to 0.5%. So when you start factoring that in, it adds a lot of fear. And add to that, we have a slowing economy, but our employment's actually getting better. I know that sounds strange, but people are actually going back to work. Our employment rate is actually increasing because our participation rate is increasing, and that's a good thing. Actually, the quitting rate, the rate at which people quit their jobs has been increasing, and that is positive too, because that shows that they're actually they think that they can get another job or a better job. So that's very positive.
It's kind of an odd thing to be positive about.
It is.
The quitting rate. Yeah.
The quitting rate, yeah.
But I guess to come full circle, the reason part of our economy is slowing down, and it's not just going but gangbusters. And a lot of that has to do with what's going on around the world. The global economics is not that positive. And where this can add some volatility to us is if the Fed starts to raise interest rates when the rest of the world is not. They're actually going the other way. It can hurt not only the U.S., but it can hurt the world economy as well. So, not to say that we're going to go through another 16% drop, but I don't think it's going to be a very smooth sailing upward trajectory from here.
Yeah, and you and I were having a great conversation last week about it's kind of like, what do? Do you rip the Band-Aid off, or do we keep it on and just keep pulling it off and putting it back on and pulling it off and putting it back on? And I think that's the biggest question that the Fed is facing right now is what do they really need to do? And of course, getting people back to work, getting these companies spending money is a big part of that. And it all has to come into play. And I can't not mention we got elections coming up. So how is that all going to play a part with us?
Well, that's the crystal ball. I think if you could remove politics from the whole thing, we'd have already been on our way and things would have been improving. But, like you said, if we're lightly pulling the Band-Aid off or ripping it off, that's getting the problem and fixing it very quickly. But if we continue to hold hands and promise things are going to get better without any real action, we're going to see exactly what we've been seeing: no real growth, slow unemployment, and the market that's just not doing a whole lot, and that's difficult, especially for retirees. Because we don't want our retirees to be living off of the volatile stock market. I know they need some, but we don't want to be living off of that. We want good interest rates, and we want good CD rates where our retirees can feel safe about taking their income. Mm-hmm. And that's just not where we're at.
No, it's not where we're at. So it's kind of forced environment. Well, we sure do appreciate you being on the show this month, and maybe next month we can get a little bit more focused about where we could possibly take some other sources of income besides having to rely on these big stock market dividend paying stocks. So that'd be great.
Thank you all for having me.
So thank you, Aaron, again. And we appreciate all of our listeners every week. Make sure you email us any questions, lifeplanning@kennedy-financial.com, and just wish everyone a great week and God bless.
As always, Angela Robinson, we appreciate you and everyone at Kennedy Financial Services. Tune in again next time, folks, for more Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Securities and investment advisory services offered through VSR Financial Services Incorporated, a registered investment advisor and member of FINRA SIPC. Kennedy Financial Services is not owned or controlled by VSR Financial Services Incorporated.